y'all, it's Steffi. Welcome back to my channel. Today I'm going to attempt to explain an audit of financial statements from start to finish in basic layman's terms. Hopefully it will give you a better idea of what I do as an external auditor, what it's like to be in audit in public accounting. This video will not be comprehensive though. There is a lot more to audit than what I'm explaining today. There's a lot more technical aspects, very specific things to do with audit, which you will learn in school and on the job. I have a video where I do just kind of a basic overview of what audit and accounting is. You probably will want to watch that video. If you have no idea what I'm talking about, go ahead and watch that video. It'll give you a better idea of what I'm talking about, and hopefully once you watch that and you come back to this one, it'll make a little bit more sense. I will link that all down below and in the cards if you are interested and want to look into that further. I like to break up an audit into 5 steps. That being getting the client, planning, execution, reporting, and then archiving. Or concluding, whatever you want to call it. I'm not going to go into a huge amount of detail of the first step, which is getting the client. Many audits that you will be on will be for recurring clients that have been audited by your public accounting firm for a few years or many years, however long it's been. But just to give you kind of a brief idea of what it's like to get a client, because I've only recently been a part of that from start to finish. Typically, there will be a prospect, some company that needs some kind of an audit or some service from your public accounting firm. The partner will take either a senior manager or a manager with them to go and do the proposal or just to present what your firm is all about to the prospective client. I've only been on one of them, and if you are part of my subby family, you know how that went. But I will say we did get that client, so I'm very happy about that. I will be more confident and relaxed in the future. Anyway, another story for another day. You'll typically have a fee in mind. The partner and manager, whoever's going with them, will put together some type of budget where they estimate the number of hours, which helps build into a fee for the overall audit. Propose that to the client and kind of goes from there. Engagement letter, that basically is a contract between the public accounting firm and the company to say that yes, this firm will be doing our audit, and everyone signs off on it, which includes the fee and all this other contractual stuff that goes into that. Going into the planning phase, you always have to have an engagement letter, whether it is a new client or a recurring client. You always have a new one for each year. You'll also have a budget that you put together every year as well. And it's a lot easier when you have prior years to look back at. You can see how many hours it actually took compared to what you thought it was going to take in the previous year, and that way you can always refine and make it a bit more precise. You're going to do all the work that is required of you as an auditor, but you also want to try doing things with efficiency. Public accounting firms are businesses as well, so they need to make money too. Typically, if you're on a bigger client, that'll be in the summertime. That way, you know, you're not trying to do everything during busy season. So usually in July through September-ish time frame, you're doing planning. It is what it is. It's planning. You are determining exactly how you are going to get the audit done to meet the specific deadline. Something that is done from staff through partner level. Usually staff are the ones who prepare stuff, as well as the seniors will prepare more of the technical things, and then the staff will help with the less risky areas due to experience, obviously. And typically you're out at the client during this time as well. You're gaining an understanding of the client and their business, so that could be reading their prior year reports, that could be looking up information about them online, doing Google searches, reading their website, just trying to get a better understanding of the company and their actual business for discussions with management, the actual people at the client. It is just not possible to audit every single transaction, every single item that goes onto the financial statements. I mean, it's just not practicable, and it's not required based on the standards that govern auditors. To pinpoint exactly which areas we want to focus on, we use something called materiality. Materiality is what we estimate would be the amount that would affect a user of the financial statements decision making. So let's say you're an investor in Nordstrom. Are you going to be swayed by something that's off $100, or are you going to be swayed by something that's off $1 million when you look at the grand scheme of the business? Every firm has different methodologies for it, different ways of calculating it. Typically, it is based off of a percentage of, it could be income, it could be assets, equity, net revenue. This is what we would determine to be a material or important number or balance. As you're going through your audit and you're doing the execution phase, if you're finding errors or differences, and if those add up to an amount that reaches materiality, then as an auditor, we determine that the financial statements are materially misstated. Have a bunch of errors that do not fall to, let's say, $1 million. Let's say it's all these errors, they aggregate to $500,000. Well, we would still determine that the financial statements are not materially misstated, which is the opinion that you will see auditors giving. The financial statements as presented are materially correct. If you had errors that were above $1 million and the company did not end up booking them, then obviously you would have a material misstatement in the financial statement, which might affect the decision making for those users of the financial statements. There is an amount that is a percentage of materiality that people will call as de minimis or a trivial amount. Like, we don't care about that amount, okay? Let's say it's $100,000 is your trivial amount. One area had less than $100,000 in differences. A-okay, I don't care. Pass on it, we're all good, okay? Obviously, if there's no fraud involved. Take what I'm saying with a grain of salt. Let's just say easy peasy what I'm talking about, no fraud involved, just human clerical errors, etc. When you are planning your audit procedures, you look at something called performance materiality. That is an amount that is slightly less than materiality that you are actually using to plan your audit. I had $1 million as materiality. Let's just say my performance materiality is $600,000. The next step is to go in and start looking at which financial statement line items are going to be scoped in, or that you are actually going to perform audit procedures on. For example, we're taking this financial statement and I'm looking at every single line item to see, okay, is this amount over $600,000? If I look and I see that these amounts are, then I say those are scoped in, or I'm going to audit those amounts because they are quantitatively significant. There's an additional piece where you use your auditor judgment to see if something is qualitatively significant. So let's say that you are a retail store, like Nordstrom. Let's just say it's like Nordstrom, okay? Let's say that their inventory amount was $500,000. But because of the business that you're in retail, things can get stolen from either consumers or internally. Using my auditor judgment, professional judgment, I would determine that although this amount is less than my performance materiality of $600,000, I'm still going to scope in or test this balance. So I would still pick that balance to also test. So that's a qualitative reason for scoping it in. Once you have all of the areas that you know that you want to perform audit procedures on, the next step is to perform a risk assessment, which is basically looking at the various line items that you've picked and saying, what in this area, let's say inventory, what are the risks? What could go wrong in these areas? A risk is theft. Products that are slow moving or becoming obsolete. That could definitely be another risk, that you have inventory on your balance sheet that no one wants anymore. Inventory is considered a current asset, so that would be something that would be sold or used within a year. You're identifying where the risks are in your audit, and then you go in and you design procedures to address those risks. Part of understanding where all the risks could be is doing walkthroughs of processes and controls. Now this I will just be very brief about. It deserves its own video. If you know me, you know this is the part of accounting that I am passionate about, that I have the most interest in. So I feel like it deserves its own video. You sit down with people in accounting or in operations who are actually dealing with the things that end up on the financial statements, and you talk through the entire process from start to finish. So when we're talking about inventory, from purchasing or buying it, how do you receive the goods, keep track of the inventory in your warehouse, how do you keep track of the cost of all the goods. So you basically walk through that entire process from start to finish of a transaction. And within each of those processes, there are controls, and controls are checks and balances that ensure inventory isn't getting stolen or used in an inappropriate way, or that it's being recorded on the financial statements incorrectly. For example, you have this handbag that costs $100, but it ends up going into your general ledger system as $50. So there are controls to ensure that that doesn't happen, or that if that happened, it would be detected, in a timely manner. People who deal with that, usually controllers, CFOs, accounting managers. There's a lot of meetings involved, and then you go back and you type everything up and you document everything. So once you've done all of that, you sit down and you think, okay, how am I going to make sure that it is not materially misstated? There are a combination of different tests that you do to verify it. One of them is an inventory observation. An auditor will go with them, observe what they are doing, that they're doing the count correctly, and we'll do tests of our own where we get a listing of all the inventory, and we'll pick things from the list and try to find it in the warehouse. We'll go in the warehouse and randomly find like something on a shelf and try to trace that back onto the inventory listing. Pick a certain number of samples, let's say it's 10, and you'd verify the pricing on it. So you'd get the invoices from the manufacturer who they bought it from and see that the price was, yes, it was $100, and that agrees to your inventory listing, which agrees to the general ledger. That is what we call substantive testing. Could be an analytic. As the auditor, come up with your own expectation of what the balance should be. An easy example of that would be a payroll analytic, where you look at what your prior year payroll expense was, then you compare like headcount from the prior year to the current year, and that can kind of give you an idea of what you would expect based on turnover or added employees, what the current year expense should be, your own independent idea of what you think it should be, and then you compare it to what was actually recorded on the financial statements, and then whatever the difference is, you will typically have some type of threshold. If the difference is outside of this amount, then I need to do more procedures, but if the difference is within my threshold, then I'm good, and that's the end of the analytics. So that's another substantive procedure that you can do. If there are good controls in place, you could do test of controls to alleviate the amount of substantive testing. Company has enough checks and balances in place, so we are comfortable to say with all those checks and balances in place, this amount must be materially correct because they have such good controls in place. You do have to do some type of substantive procedure on top of a test of control, but it can substantially reduce the amount of testing. So like I said before, let's say you did 10, but if you did controls testing, maybe you only have to do 1 or 2 samples. So it can definitely make a huge difference, especially in areas with bigger samples. Stuff like revenue will typically be a big sample because of the amount of revenue. As you are doing your planning procedures, you are trying to determine if there's anything you can do to make a most efficient audit. In a very long, big nutshell, that is what planning is. And hopefully you've done enough during your planning so that when you actually go in and execute your audit, there's a lot of work to do, but you have a very good game plan. Because remember, if you fail to plan, you're planning to fail. Okay? I very much believe in that. Now it is time to actually execute and do your audit procedures. For your balance sheet accounts, which are your assets, liabilities, and equity, you have to test those as of the accounting year end. So let's say you have to do it as of December 31st. Your income statement accounts are a throughout the year amount. To attempt to alleviate some of the work that you do during busy season, you try to do more of the larger volume work before busy season starts. So We call this interim work. And this is typically done within like the September through December time frame. And you can do certain tests like revenue. Take all the revenue from January 1st to, let's say, September 30th, whatever your time frame is. You make your samples based on your firm's methodology, 75 different sales transactions. You provide that to the client. They provide you with evidence that they received payment, evidence of delivery of the good or of the service, so that you're not doing 100 samples in January. Instead, you're only doing like 25, depending on how big your sample is. If you are on a client who is a public company and they are SOX 404 compliant, which is controls related, at the end of the year, you have to say whether the controls were operating effectively. To do that, you have to test the control throughout the year. Fourth step is reporting. So you're doing all this audit work. Why are you doing it all? At the very end of the day, you're doing it because you want to make sure that the financial statements that the company is going to give out to the public are the be-all end-all of your audit. Trial balance is like all of these accounts, different categories of where you put certain business transactions, and you take that trial balance and you group them, which is called mapping. Let's say you have 15 different cash accounts for whatever reason. You have 15 cash accounts. You group those all together and they go into one little line item on your balance sheet that is cash. And so that's called mapping. You have various expense accounts. So let's say you have 25 different ones of like payroll expenses, office supplies, training, and all of those total up to one line item, which is your general and administrative expenses. All of the accounts that you have tested and you know that they are not materially misstated, that they are grouped properly on the financial statements. So typically the company will put together the financial statements and then footnotes, explanatory paragraphs. And what we do is we verify, okay, here's the balance sheet. I can tie out all these numbers on the balance sheet to the trial balance that I audited. When you add up these trial balance accounts, that total amount is equal to what is on the financial statements, and that's what agree means. You're making sure any of the calculations are correct, so you're just using your calculator to verify that's all correct. Make sure that your footnotes are consistent with what is on your financial statements. So if you have a footnote about accounts receivable and the footnote says we have accounts receivable of $50, but your balance sheet says 60. If you do find errors, be calm about it. I know when I first started as a staff auditor, you find the first difference that is, above a trivial amount, and you're just like, oh my God, I got them, fraud, these people don't know what they're doing. Just slow your roll, it's okay. You go talk to your senior or your manager, tell them that you found this and that you're gonna go talk to the client. You go talk to the client and just ask them like, I did this test, compared it to what you gave me. There is this difference, can you help me understand? Could definitely be incorrect because of clerical errors or interpretation of accounting standards, or you might find out that, oh, I just gave you the wrong piece of support. And so once you do all of that and everything's good, the partner's good, everyone's reviewed things, then you issue the opinion and then you're all done for the most part. Fifth and final step is archiving. Clean up all the documentation, any review comments that you may have received, then putting it into storage, which usually is through just electronically. That is what an audit is all about. This video is already super long, so I didn't go into detail about who does what. So I can always do further videos about that, about specific roles in an audit, but that is basically an audit in a very long nutshell. I just hope it made sense. So much to it. Anyways, if you found it helpful at all, if it gave you a tiny bit of insight into what an audit is all about, please give the video a thumbs up. Hope y'all enjoyed it. I will talk to y'all in my next video.